Welcome back to a Market Matters video, everyone, and Happy New Year. I'm joined by James. Now we're kicking things off for 2017. Welcome, James.
Thanks.
Hope you had a great break.
I did, yeah.
Fantastic. So, what we really want to do, obviously it was quite a busy period. People would have got a lot of alerts over that New Year's period. We've sold 4 stocks and we've actually bought another one today. Firstly though, I really wanted to talk about the index and get the updated perspective on what we're seeing. Obviously we've seen a very strong run. Do we expect more upside, or is the selling for, because we're anticipating lower prices?
Yeah, hi Nick. A great run by the index. We were targeting sort of that Santa Claus rally to play out 5,700 by the end of the year. That played out, which is obviously nice for us on reflection. Yesterday the market traded up above 5,800, 19-month highs. So clearly we're seeing a lot of strength in the market. Volumes have been low, so that's the cautionary note that we need to keep in the back of our minds. As you made mention of, we've been using strength as an opportunity to reduce our holdings, increase our cash. Now that's not an overarching view of ours to turn bearish at this juncture. We wrote on the weekend report this week that we're anticipating an 80-90 point retracement in the short term. We've got sort of 60 points of that playing out as we speak on the market today. So a short term pullback in our view. The market then pushes higher, and if we get above 6,000, we then become more bearish. The market, we then position for that deeper correction that we've been flagging for quite some time. So broad index levels there for you, Nick.
Okay. Firstly, just want to delve into the banks. Get a lot of questions about the banks. We get a lot of people that hold the banks for the longer term and are not necessarily that worried about gyrations of 4 or 5% here and there, and happy to just pick up their dividends. What are our thoughts on the banks in 2017?
They were cheap before, they're now reasonably expensive. So we were overweight the banking sector when a lot of people didn't like the banks. There was a truckload of rationale reasons not to hold CBA at $70, or that's what the broader investment community was thinking. We held CBA, we added to a number of other of our positions in the banks. And now we've enjoyed the strength, and now we're reducing them. So to us as investors, we tend to go against the grain, or try to go against the grain of the broader market. So we're now seeing a lot of positivity around the banks. I spoke last year around the tailwinds for bank earnings being higher interest rates, and also being reduced capital levels for the banks. So that was a major headwind in 2016, back end of 2015. That has gone, but I still don't think it's the time to get overly optimistic at the bank. So we're retaining the view of selling strength and buying weakness if it prevails for Q1 in this year, and that applies to the banks as well.
Yeah, we just took a little bit of a profit on Westpac. CBA's up around that 85 mark, it's gone a little bit lower today. We did talk about Bendigo in the report this morning as a potential buy, a little bit lower than where it is now. Is there a particular favourite? Is it Bendigo, or is there one of the big 4 that you'd add to around here if you had to buy one?
Oh, I mean, Bendigo and CBA, they're next to GoX. So, ANZ's re-rated, and they're changing their sort of business model, moving away from Asia. They're going and sacrificing earnings to clean up their operations and I guess redeploy capital into areas where capital is getting a better return. That was the issue in Asia, that they were deploying too much capital for the return they were getting, so now they're redeploying elsewhere. So to me right now, none of the banks really float the boat in a valuation sense. They did at lower levels. Right now, as we have been, we've been on the sell side. So we highlighted Bendigo, slightly lower levels for the dividend. But again, it's not as compelling as it was at lower levels.
Okay, and then the mining space did well, started last year, don't have any real positions at the moment. The last one we have with Independence Group, which was a relatively good one, relatively medium term. What are we seeing there? Is there any interest in BHP, Rio, Fortescue, these sort of stocks, or not until iron ore comes off somewhat?
Yeah, well, gold, you've got to be trading in the mining space as our resources are trading vehicles. So, we're looking for an entry into gold. We haven't, gold's come back. We haven't got our entry into gold yet. If you think about, the resource stocks, they've come upgrade. Analysts have been upgrading earnings based on higher commodity prices, which goes, that's a typical thing that happens. But they're behind the curve. We've now seen commodity prices roll over or start to roll over. Iron ore is 10% below its December high. Met coal is 33% below its December high. Manganese has just started to roll over. So some of these commodities are actually starting to roll over, and our view is the mining stocks will come back in line with that. So no interest in the sector at the moment.
Okay, and also as well, you touched on the gold space just briefly there. Gold did come all the way back to the mid 1100s, even below 1150, which is the level that we call a technical level. It started to drift a little bit higher, but hasn't really broken out. However, some of the gold stocks have seen a little bit of buying support. You know, Reed just got into the mid to low twos, and is now on $3. You know, is there an interest there, or are we waiting for a bit of a shakeout in the space and a bit of a low, you know, to enter a position? Because historically we have traded the space.
Yeah, I agree. It's obviously a trading area of the market. We've had a big correction. We've had sort of an anemic counter trend bounce. I don't think that'll last. I think the US dollar will go higher, and that'll keep some pressure on gold in the near term. So no interest for now, I think.
Okay, and then stock that we bought just before, a bit of platinum, 5% of the portfolio. You talked about in the alert the fact that December they had some outflows, but not as substantial as the previous months, and also as well analysts have we're a lot more bearish on the outflows. You know, what are we seeing there? Is this a play we're trying to get set ahead of time? You know, over the medium. What's the time frame on this?
Yeah, you got to be in something before the wider community, I guess, jumps in and buys the stock and bids it up. So in a really short perspective, platinum trades on 15 times, which is a discount, a reasonable discount to the market. It's at a substantial discount to its peers. Magellan trades on 20 times. Now the issues within platinum are well known. They've had poor performance. They're an primarily international fund manager. Their performance has been below the index, and that's why we've seen big outflows of funds going out of platinum. But if you think about the outflows last year, there was about 1.5 billion of outflows. In the December month, they had 97 million. The market was anticipating more outflows than that 97 million. So, we might be a little bit ahead of the curve, but those outflows are staying at the bottom, and performance is starting to show tentative signs of improving. So, these guys, if the market continues to perform well, there's generally a lag between when how well the market does and when funds come in. So, we're buying a stock that's cheap, it's unloved. You look at the consensus from brokers around the place. Most have got a sell on it, or at least a hold on it, and a price target that's around current levels. So it's a contrarian play. So it's looking for value in the market.
Awesome. Just two last ones I just wanted to get your quick take on, ones that we do hold in the portfolio. One being Mantra, sort of building a bit of a base around that $3 mark. Hasn't really gone anywhere. Obviously the rising Chinese middle class, it's a good story, but hasn't quite moved. And the last one being Healthscope, was treated as if it had a massive downgrade, but it was probably just a one-off blip. We've actually seen it sort of find a bit of support. Now looks pretty good in the 240 range. Both of these stocks, would you be a buy today?
So in regards to Mantra, Nick, so it has been a little bit frustrating. We like the underlying themes of Mantra. We like the company from a valuation standpoint. We think it's got reasonable growth, and they're doing good things. The stock just hasn't moved. So at the moment we're being patient in it, but it's clearly on our radar whether we cut it and move elsewhere.
Do you think any of it's sort of Trump related in terms of Trump getting in, some of the stuff he said about the Chinese, or not so much? It's just something that's had no news and it's not in the right space at the moment.
Yeah, it could be. I mean, the market can be fickle at times, so it might be related to that. It's obviously had some negative news around the Dreamworld tragedy up in the Gold Coast. So there's probably a couple of things that are weighing on it, but a stock like that, it should, in our view, it'll attract some attention and start to move higher. And you mentioned Healthscope, so we bought that after the downgrade, or the downgraded guidance. It wasn't really a downgrade; it was potential for downgraded guidance. So we like the story. I've spoken about it on these videos a number of times before. So we think it's a stock that you can be held in portfolios. We've bought it at lower levels. We're looking to add to it if it drifted back to 210. It didn't. So we've still got a reasonable holding in the portfolio, but we won't get married to it either. We won't. We'll cut it if it trades up around 260, 270. I would imagine.
And someone with that exposure wouldn't necessarily be jumping in a pin in the ears back at current levels?
Yeah, the risk reward doesn't really stack up right now. So to buy closer to $2, so 210, 220, and it's probably a sell at 270. And if we're trading at 245 at the moment, it's a bit too hard.
Not really much of a yield play. You're better off in the bank.
Yeah, well, your risk reward doesn't stack up. So Healthscope's not a bad yield play. When we bought it at near around 220, it was yielding around 4%. So reasonable yield. Particularly relative to Ramsay. So, no, it's a good stock. It just, risk reward doesn't stack up right now.
Awesome. Thanks, James. Thanks for a very comprehensive update. Now, everyone, please watch out over the next 4 to 5 days. Worst case, next week, we're going to have an outlook piece out to you, which will really emphasise our views for the year, what we're expecting, should be able to act as a real sort of roadmap for how to play the market this year, and that should be out sometime in the next week. Now, if you have any questions about this video, please reply to this email, or you can always give us a call on 1300 301 868. That was 1300 301 868. Thanks again, James. Cheers.
Thanks, Nick.